was to go through the midterm exam. I know I got those back to you. Everybody did great. The way I grade them is, I look for, obviously it's hard for me to see because I'm not looking at your computer and your screen and things like that. But the PDFs, everybody did a great job getting those to me. And I was able to grade them just based on the numbers that I saw on the forms and the forms that would come to me. But I wanted to kind of go through that for everybody to kind of see some of the things, some of the errors, things like that you may have made. It just allows us to kind of, like I said moments ago, give a little recap as to what went on with the midterm as far as everything that was on there. Everybody did great on the written portion. So I was thrilled with everybody's job there with that. Just thought I'd go through that. So I'm going to share the screen here with the return. If you remember, we had the Jensens was our family, okay? I did look at the content on the main info sheet, as far as, anything that you would put on there, all the information that everybody would go through. Obviously, the filing status, very important because as we've talked about, that drives our taxes, the tax table that we use. Obviously, we had, typo there, get that one fixed. Okay. Obviously, it was driven a little bit by the return as far as the kids that were on there, their ages, that they were on there for the different credits, both the dependent care, and as I told you, always check that EIC. We were doing a New York return for them. I looked to make sure that you had the bank information in there correctly. All right. That was going to be e-filed. Again, didn't worry about the driver's license. That wasn't anything that I looked at. Okay. And as far as the bottom, some of you, good thing that it was attached to your email address because without putting that preparer's name in there, I wouldn't have known whose return was whose. So, it's kind of like going back to grade school when the teacher would say, make sure you put your name on your paper so you get credit for the work that you did. Okay, so, when you PDF in something like that on the midterm or the final, we want to make sure that down here at the bottom where it says preparer's name, make sure you type your name in there. Because when you print a PDF on that file copy, that first page will have your name on it so I can make sure I know who's who. Okay. All right. As far as the return itself, okay, we had W-2s, which everybody did a nice job with. Okay. Those W-2s on there, we had one for Care for All that we had for Mrs. Jensen. She had her income and she had her state tax withholding. As I said, a couple of returns, it looked like there was some state tax withholding missed. As I talked about, when you do the software and you come up and you open up that W-2 and you kind of scroll here and you get to this part, sometimes that little line down there, boxes 15, 16, 17, 18, 19 along the bottom, sometimes it kind of out of sight, out of mind, and we'll forget to add. And even on the W-2, it kind of hides down there at the bottom. So make sure you're getting that income on there, okay? We had one for James. He worked at a place called Candles and More, okay? We had that on there. The big one on this one was box 10. We had a few errors with that. Make sure you had that $1,000 in there for dependent care because he was given a benefit at his employer. Makes a difference on the credit when it calculates on the 2441 that we'll see here shortly. But, make sure, again, that you get that on there. And also make sure that you had the state tax down at the bottom. Okay? All right. The next thing we had in there that we looked at was the interest income. Okay? And the interest income, we had that. One thing I want you to remember, and if you want to make a note of this, we're going to talk about a couple other forms today, but the Schedule B, the Schedule D, And then we're going to talk about one more. This is the 4562 for depreciation that we'll talk about today. Those three forms are the forms where information goes on for the return, because those are what are filed. But each of those three forms, the B as in boy, D as in dog, and the 4562, you do not put the information directly on those forms, okay? So for our interest in our dividends that we had, it flows to the B, okay? But always make sure that you go in there, you hit F9, and inside there is an interest statement, okay? So with that interest statement, when we open that up, we're going to see this one here that has the grid, okay? That's where we want to put this, because this allows us to do, for box 1 or 3, the amount, allows us to do the state adjustment, if there's exempt interest, if there's an early withdrawal penalty, and tax withheld. We can do it all right there. From this worksheet, it will flow everywhere it needs to go on the return. It'll go back to the B where it needs to go. It'll go to page 2 of the 1040 where it needs to go. We're going to talk about adjustments to income, so that early tax penalty will flow where it goes. The exempt interest will go. The state adjustment will go so that bonds and such that are not taxable on the state side will flow over there. So always make sure you use that, okay? So again, on the Schedule B, you go under where it says Other Interest, okay? Some of us had the interest up here. That is for somebody that holds a mortgage, okay? So if I sell somebody a house that I own and they just can't afford to get a mortgage, so I hold the mortgage for them, just like the bank would do, I'm going to declare that interest as income on my tax return, and that's where I do it. Our interest that we see, CDs, savings accounts, escrow accounts, interest like that for personal interest income goes on here, okay? Did have a couple instances where somebody had their interest from the mortgage. Well, that'll be on the Schedule A, as we'll see, but that's where this goes, okay? Equally, down at the bottom, under Part 2 for the dividends, same thing. We're on the Schedule B, hit F9, we get a little dividend statement, okay? And once we go into that dividend statement, all right, let me get my picture out of the way here, okay? We have our ordinary dividends and our qualified dividends. And again, if there's any state adjustments, if there's any capital gains, that'll flow to the Schedule D for us that go on that dividend statement. In this case, we had some tax withheld. That was a little bit, some of the tax withheld was missed. That's where it would go, okay? And that will then flow to page 2 on the 1040 under payments, where the tax withheld goes, just like from a W-2, okay? So always make sure that you're using those worksheets. And again, that's for the Schedule B, D, and the form we're going to talk about today, the 4562. Okay? All right. So as we're moving down, whoop, got a question here. Hold on one second, wait for the chat to come up. The foreign tax, yep, there we go. Line 48 of the 1040. Thank you, Dave. So Dave must have saw the message faster than I could see it. So yes, it goes on line 48 of the 1040, okay? So it does not go on that Schedule B, okay? So we don't put it on the Schedule B there. As Dave said, you can put it right there, okay? On line 48 for the foreign tax credit, okay? Which we didn't have anything on this one, all right? All right, so we have the dividends. The other thing that came up was unemployment. Everybody did pretty good on that. You know, if you go in there to line 19, and again, I'm an individual, and the way I learned the software, 8 or 9 years ago when I first started working for Esther, I was driven off of the 1040 because I knew, okay, everything's inevitably going to end up there. I want to make sure that I understand where it goes and how it gets there, and that was where I knew if I did something in that square, it would come back to that. That's where this one, we have the option. You can see there's an option for a new one, but in this case, we had unemployment benefits for our state employment. So we open that after hitting F9 in the box, put that in there. And again, be very careful with the state withholding. You have to make sure you put your state designation in there. So I got my New York in there, and then I put that state in, okay? Some of you put the state tax withholding, but it never carried where it needed to because there was no New York there on line 6, okay? All right, so we have that. We had some gambling winnings, okay? So again, if you have a yellow number that's here, okay, that means it's calculated, it means it came from somewhere else. So in this case, it comes off of our line 21. We go in there, hit F9, light the box up. We get our 1040 worksheet 7 for other income, okay? And again, gambling winnings, if we have a form W2G, which we did, we go in there and hit that, okay? And we can put that in there on that for the lottery winnings. And we had some tax withheld. Again, don't miss that tax withheld. All right, every once in a while somebody was just a little bit off, and even just looking at the returns that were printed out, I could tell by the numbers what was missing. So I could go and find that. And then down at the bottom, again, out of sight, out of mind, that's where that $1,000 goes in. That's going to carry over to the Schedule A for our itemized deductions, okay? So that gambling loss goes right there, okay? The software will adjust. So even if I put 2,000 in there, it would only give me 1,500 based on this form. If you do not have a W2G, okay, if you do not have a W2G, you would be able to put it right here on line 17, say gambling winnings, put the amount, and then you'd have to know to go over to the Schedule A in that other deduction area that we're going to see here in a bit, and put that there, okay? All right, next up was the total income. And again, if your AGI was off because of something you did here, I didn't mark off, you know, total points. If I felt like you had it, you just missed some withholding, or maybe something didn't quite get on the right form, I would take some points off for it. But you know, that adjusted gross income was an important number because it flows over to page 2 where we do all the rest of our calculations, okay? So we have our tax, our AGI came up to the top here, so our adjusted gross income. We're going to have our standard or itemized deduction. In this case, we were able to itemize, okay? So our Schedule A, we didn't have any medical, so we didn't have anything to worry about there. The income taxes, that is the line 5A there, that's the one we used, okay? So that's the one that we used on there that would come over the tax withheld from the W-2s or anything else that had state tax withholding. It would flow over there to state and local taxes paid. Again, this is a section for 2018. If you look, 9810, this section is going to be capped at $10,000 for everybody. So you look at a return like this, pretty common return with things with income, mortgage interest, things like that, property taxes. You can see how in New York, that is going to hurt some of the taxpayers on itemizing because he's very close to his $10,000 limit. We did get the new software this past week for 2018. I'm hoping at some point on one of the classes I may just kind of show you the way that the postcard system is going to work, which is really a fallacy. It's not a postcard. It's still a bunch of forms. But that's where that does. And you'll put things in there just like that, and the software will cap it, okay? In this case, we did do the calculation for general sales tax to see which is better. Usually that box will pop up red for you. All you do is hit F9. You go into your sales tax worksheet, and you open that up, okay? In there, you're going to go to the section that talks about sales tax deduction. Since we're doing a New York return, we did that. In the one section that talks about the sales tax, there's the little tables. So for various states, or if you don't have state income tax, you don't have to worry about this. But we put everything in there. And again, motorized vehicles, if you bought a new car and they had sales tax, you can put that in there. Now, in this case, and in most cases, when somebody has W-2 income with state tax withholding, you know, their state sales tax, even if they bought a new car, is probably not going to exceed their sales tax withheld. but I always go back to retirees that don't have a lot of state tax withheld from their retirement or their Social Security. Sometimes that general sales tax, if they itemize, is a good thing to look at, especially in a year that they maybe bought a new car. Okay. All right, so we have off the 1098, we had our real estate taxes paid. We had our interest paid. Okay. All right. And then we had mortgage insurance premiums. I know that was a little unsure in, and I had a lot of questions come in about that through the chapter and the exercises and the book problems, the workbook problems. But that is a section that is deductible. It was not deductible at the start of filing season for 2017 tax year, but about midway through February, they decided to put it back in there. Okay, so we have that. And then we had gifts to charity. We had a couple different things. So again, there's a little worksheet in there. So we go in there, we can light up any of the boxes in the gifts to charity, hit F9, and we're going to use our detail sheet for itemized deductions. And that's that little detail sheet there. Okay. Up top, we didn't have any medical expenses on this one, so we didn't have anything to put up there. First Baptist Church, there is the cash contributions. You can see the cash contribution section, First Baptist Church. And then we had some non-cash to Goodwill for $330 that goes down here. Okay, so that's where we did the charitable contributions. Okay. On this problem, since there was not mileage for the W-2s, we did not use the 2106. Really, the 2106 or 2106 EZ, really the only time you have to use that for business expenses is if there's mileage involved, and then it works very well for it. Otherwise, we can put it right on here. Okay, we can do one of two things: put it directly on there if we just have one, or there is a little business expense thing that if we have multiple things to list, say that we have union dues, safety clothes, training, license, things like that, that we're not, that we're more than one, we can do it on that line there. Okay. But in this case, we just put the 550. We had our safety deposit box. All right. And as we see with the 2% that is still in effect on the 17, but this is the whole section right here. So basically what's happening for 2018 is that this whole section right here that I just put in the red box disappears for 2018. However, New York State has divorced the IRS, as Esther likes to say, and seeing that they want to do married filing, separate filing for New York, they have decided that they're going to allow all this on their return. So we haven't, with the software, had the New York software come down yet. We just have the federal. So we're not sure how it's going to look as far as having that New York where they decide to have that in there. Okay. Other states are doing the same things. Obviously, if you don't do state returns, then you don't have to worry about it. Okay. Down here at the bottom, since this is in yellow, this is what I was talking about, the W-2G. Other miscellaneous deductions that will still be there, and actually gambling losses have been expanded to include things for travel and things like that for 18. But in 17, on the W-2G, it flowed over here, excuse me. If you did not have a W-2G, but they disclosed gambling winnings and gambling losses, again, line 21, you just go down to one of the blank lines there in the worksheet 7, put that in there, and then you'd come over here and pop this open, hit F9, and inside there's an others deductions line, and you just would have to manually. So you'd want to use that little worksheet manually and type it in so that it would go in manually the 2 spots. The W-2G is very nice because it allows you to have it flow over there once you put it at the bottom of the W-2G. Okay. So that got us our itemized deductions. The software does the calculation for us. Okay. In this case, it did a Schedule D worksheet because of the dividends. So we had some capital gains, and that's why it did that. It did the little worksheet that you see lit up on the tree over here. Oops, I get to light up there. Okay, so we have that one. Our dependent care. Okay, so we have this one. this form would have automatically lit up and been on your tree on the left, the 2441 form, when you check the DC box after the dependents' names. So we had mother's helper, we had the income there, okay, and we put that in there. Now, one little nuance here that happened, we had Sammy, we had Sally, and then if you looked at your tree on the left, you had this little worksheet that popped open, and down at the very bottom is kind of an overflow, okay? So what this is this is where Sarah ended up with her 1,000 because of the overflow of only having space for 2, okay? A lot of you caught that. It was a little nuance that was in there. I guess the writer of the exams decided to throw one little curve in there that we really hadn't seen or had to do so that nobody would get 100. But, you know, that was where that little nuance where that would go in there, okay? We had our child tax credit of $3,000. Everybody pretty much had that. Last thing we had was the other credits. This was our adoption credit, okay? And that was that form there. So we had it where we'd go in, light up our tree, whole bunch of stuff in here. You got to kind of find it down there in the middle. So we had our 8839, and we had that on there. And it became final in 2017 or earlier. That was the case in the description. And again, the credit is up to $13,570. This was not a special needs child, so they only got their actual out-of-pocket adoption expenses. And again, dollar for dollar credit, non-refundable credit in the year that it's taken. So that was a huge help, okay? So that flowed over to our non-refundable section, kind of that other credits on 54, and had it there. So that got us down to that. Again, federal tax, everybody was pretty good. A couple times I had some people off by $200 or so. And again, a lot of it boiled down to some of that withholding that was on the dividends and or the self-employment, okay? All right. And so that got us to the refund, the $31.39, okay? Nothing really on the New York side on this one. Everything pretty much came over. You know, I didn't get too caught up in the headers and stuff like that because we do have people that are not doing New Yorks and stuff like that, so I wasn't too worried about it. But we do have all the information that was on there. Our income would flow directly over, okay? We didn't have any real special adjustments, additions, or subtractions that were here, okay? Again, if we had something, that's where that Schedule B little worksheet's so important, because if we're able to do the interest income on U.S. bonds you see on 28, if we use that Schedule B, that worksheet that's buried in there, that's where we want that to go, okay? Tax was pretty straightforward. Child credit, we had the dependent care credit for the daycare, tax withheld, and that's where we had that. And again, couple I could tell were off because the state tax withheld was off. And again, sometimes it's a matter of just kind of forgetting to do the bottom part of the W-2 or forgetting for some of that tax withheld on various things like the unemployment. So you always want to double check that. One thing the software does do is usually the 1099-G will light up red for you to verify. And so when you come over to this, if it's on the New York or on any state, you know, verify that it was in there. Okay. All right. And that kind of gets us to the refund $31.39 for the federal and the state for $46. Okay. Any questions on anything there? Okay. If anybody wants to type anything in the chat, or you can pop up your mic if you want to. Okay. Oh, okay. That did catch a lot of people, Dave. That's a tough one. It's hard with the returns that we do The reason I say that is because a lot of these things, they're obviously fictitious, and we don't have the previous year for us to use the worksheet that they have there on line 10, okay? In this case, they did itemize last year. So in the box in the middle of 1040, we said yes, okay? Obviously, if you're in a state that doesn't do state income tax or local income tax refunds, you just come over, this will be red, you F3. F3s are get the red out. In this case, we have to know kind of the law. And the best way to think about this is if somebody has a state refund, okay? So if you have a state refund, and again, this is where you kind of need to see sometimes the return, but we know that the, basically, let me go to page 4, the 201, okay? So basically, in this case for them, okay, if you look here, the previous year they had this Empire Child Credit. It is a refundable credit, okay? So being a refundable credit, it's not a credit that really is anything that has to do with money that they paid in. It's a credit kind of like the earned income credit. So if somebody has these credits and they are greater than their refund will not be taxable because they're not going to tax them on a credit that they received. So what you do with that one is if you have the state refund and the Empire's Child Tax Credit is greater, which this was the case, you subtract, you get a negative number. Can't put a negative number on line 10. You just put in 0, okay? So, you know, that's kind of a little nuance. Again, it's tough when you don't have the previous year's return or any history carrying forward for somebody, but that's the best way to treat it, okay? All right, any other questions? Like I said, everybody did great on the exams. Thank you for, you know, doing it the way we did. That was my first attempt at that. Worked very well because I was able to kind of interact like I would when I do my classroom midterms where they're there and I can see their computer work. Obviously, I wish I could see your computer and see what you were doing. A lot of things that, you know, worksheets or little things that you did or didn't do. You know, I kind of know by looking at what comes to me in the printout, but everybody did great, okay? All right. What we're going to do is we're going to get into what happened to my there they go. Okay. We're going to get into chapter 12. We are going to cover 3 chapters today, but 13 and 14, really, there's not a lot in there. There's, you know, we're going to spend a little time in 13, but 14 is the main one, and we're going to do some stuff here in 12, okay? All right, so chapter 12, adjustments to income, okay? We're going to talk about educator expenses, HSA deductions, moving expenses, self-employment tax. We'll kind of come back to that a little bit more when we do the chapter 13. Self-employment retirement. We talked about a little when I was going through the exam about the Schedule B with the penalty for early withdrawal. Alimony paid. We've already talked about alimony received. The IRS deduction and student loan interest and the tuition and fees, okay? Really what the adjustments to income is, and the best way that I can think to recap it, this is a lot of things that we can do to our income before our AGI is calculated that are things that we can kind of do after the end of the tax year. You know, with HSA deductions and retirement contributions for self-employed and traditional IRA deduction for those that have W-2 income that maybe are not maxing out their 401ks. This gives us the opportunity as tax preparers to be able to help lower the tax bill by lowering the adjusted gross income on these adjustments, okay? All right, as it shows there, basically we're going line 23 through 34, okay? So those are the lines that we're going to be covering, all right? Educator expense, this is a credit for teachers. Will still be around in 2018. At first we thought it was going to disappear, but it did reappear, okay? So we have it here. All right, excuse me 1 second. Somebody's coming in here. Okay. The teachers, trust me, they'll know about this one. This is $250 per person. If you have 2 teachers on the return, it's a total of $500, which is obviously the maximum deduction, because you can take $250 for the taxpayer and the spouse. You do not get to take $250 for any dependents or such. Okay. It's for kindergarten through grade 12 teachers that work at least 900 hours, and it's also can be for an aide that works there. Again, this is something that they have to have where they have out-of-pocket expenses that they are not reimbursed for, that they have in connection with their job, okay? So that's where those are at, all right? Again, it's going to go on that line. We'll kind of take a look at it when we're in the problems as far as where it goes and where it goes in. There's a little worksheet that it has that and the student loan interest and other things that are on there, okay? But just again, know that it's for qualified expenses. Again, anytime you hear the word qualified, we've had qualified medical expenses, qualified education expenses. That means that there's a test or a list or something like that that they have to meet. It's not just a credit that's going to appear. They have to have something qualified. Qualified child, qualified relative. Again, anytime that term's used, there's probably some type of test or criteria that has to be met in order for them to be able to use that, okay? As it says on there, educator expenses over the limit. I use the example a lot of times. I have a client, she's retired now, but she used to be a music drama teacher and worked in a school district that had excess expenses to put on musicals that the school's budget and money did not cover. And a lot of times she would pay for costumes and or scenery out of her pocket. Well, that was well over the $250, especially I guess if you're doing Phantom of the Opera, and she's going to pay for the chandelier and to be there and hanging in the auditorium. So, you know, that's something that she can put on her Schedule A. It's still subject to 2% on her job expenses, but it is an opportunity for her to be able to take that. A little snippet here of our adjustment to income. This is no longer on the 1040. It's its own postcard. I'll kind of talk about when I go through each one, the things that are not going forward to 2018 or have been changed, but this is on the 17. This is how that adjustment to income section looks, okay? We're just going to skip over the business expenses of a reservist, performing artists, fee-based government officials. Nothing important in there that we will ever really use unless you are somewhere that you have a lot of military, and then we can talk about that later, okay? HSA. That is a health savings account, okay? In order to be eligible for a health savings account, you must have a high deductible plan for your insurance. Typically, rule of thumb is about $2,000 deductible, but the insurance companies do know that those deductions or that contributions, they know what their criteria is on their plans for insurance, health insurance, have to be met, and then they would be able to make it eligible for the HSA, okay? As it says there, to be eligible to have contributions made, you're covered under a high deductible plan. You cannot be entitled to Medicare. You can't be claimed as a dependent on somebody else, and you can't have any flexible spending. HSAs are money that you put in that are pre-tax dollars, and the money going into an HSA, tax-free on the way in, tax-free on the way out when you use it for qualified medical expenses, okay? Flexible spending accounts are not like HSAs. Flexible spending accounts, it's kind of a use it or lose it proposition, where HSAs will roll over year to year to year, so you can carry over any balances that you do not use. So that's where they're beneficial, and sometimes people will contribute to HSAs on a regular basis, not using them, and you can take them into retirement. HSAs can be used to pay Medicare premiums but not health insurance premiums if you're under 65 unless you're unemployed, okay? So it's kind of a way to set aside tax-free money that will never be taxed, that is tax-free in, tax-free out, okay? Now, when you turn 65, that health savings account can be used like a traditional IRA. So an example is somebody has $10,000 in their HSA. They turn 65, they go on Medicare. They're using their Part B premium as being taken out of their Social Security. They have a small prescription Part D that they pay out of their HSA. But all of a sudden, the furnace goes out on the condo that they're living in. Okay, they're in Florida and it's going to be 40 degrees, which is very cold for Florida, and they need to get a new furnace. Well, they could take money from that HSA without penalty, once you're full retirement, without penalty, and treat it like a distribution from a traditional IRA. So it is only taxable income, but there's no penalty involved. If you're under 65 and you take something out for other than qualified medical expenses on an HSA, it is a penalty. Okay, so there would be a 6% penalty on that. All right. Little rule there about last month. If one is an eligible individual on the first day of the last month of the tax year, they are considered to be eligible for the entire year. Okay. Talks a little bit about the benefits of the HSA. Okay. Again, be careful on this one. The HSA, there are times that the contributions are made through payroll deduction. That is already lowering the taxable income in box 1, so you don't want to double dip on the 8889, the form that you use to reconcile the distributions from the 8889, the contributions. Because if it's on the W-2, coded as a W in box 12, it will flow over there, okay? If you go to that one and you use the 8889, all you're going to put on there is if they made contributions, say, as a automatic deduction from their checking account with money that's already been taxed, then they can take it as a adjustment to income on their tax return, okay? Health box talks about a little thing here with the W-2s that is on that 12, okay? All right. There's the limitations of the contributions. Again, have to be careful with that. If somebody has something going on with payroll deduction, that they are taking money out of their paycheck to put in an HSA, and then they decide to make a contribution at the end of the year or afterwards, we'll talk about in a second, they cannot do the excess because then there's a penalty for excess contributions. Now, as it says here, for an HSA for 2017, all right, you have until April 17th, 2018, which was the filing deadline to make a contribution. As I talked about on the outset of this chapter, it's something that we have that we would be able to make an adjustment to income or lower their income before we go to deductions and figure their tax bill, that we could help them with in lowering their tax bill, because we could say, do you have an HSA? Do you need to put more in? Do you have, things like that, okay? So there's where we talk about that, okay? As I said, with the excess contributions, there's that 6% if we give over the limitation, all right? Again, qualified medical expenses, all right? And again, they have to be qualified. This has been changed and narrowed a little bit. When they first came out with a lot of these flexible spending accounts and HSAs, especially the flexible, they were a little broader on what you could use them on. And I don't know if anybody recalls, but you could tell when somebody's, a large employer in the area's FSA was going to be ending, because you went to the drugstore and there wasn't a single box of Band-Aids to be found, okay? But again, there's things that they have narrowed it down a little bit so that they're used for different things, okay? Talks about some of the things that you can use that HSA on, all right? Here's the form I was talking about, the 8889. The top section has to do with the contributions. Again, if it's on the W-2, it will flow to this form that, you put on there that this was already tax-free money because it lowered my taxable income on my W-2, okay? If somebody makes contributions outside of that, that's where line 2 comes in here. And as it says, do not include employer contributions, excuse me, contributions through a cafeteria plan or rollovers, okay? Because basically the tax benefit of those have already been taken. This is money that came out after somebody's paycheck went into their checking account and they decided to make the contribution. And again, that's where we can help somebody lower their adjusted income. At the bottom, where it says distributions, basically when somebody gets a form that they have that comes in that has their distributions from their HSA, which they'll get from their bank because it's usually just on a little credit card that they get to use. It's usually just a reconciliation to make sure that it zeroes out, okay? Because, you know, most people, and most of those cards now are set up that you can't use them on anything but anything that qualifies. So, you know, you can make sure that you do that, okay? Moving expenses. All right. This is one that's changing for 2018. Again, we've already seen the software and we've seen the form, the 3903, for moving expenses. In 2017, moving expenses could apply to somebody that was moving for a job or anything like that, and also the military. For 2018, the only people that get to use moving expenses are those that are members of the armed services. They have taken this out of the law for 2018 for anybody that is moving for a job, okay? One thing you have to be careful with in our area here is because of the proximity of Buffalo and Rochester to each other. There is a stipulation that you have to move greater than 50 miles. And a lot of times from where you might be in Buffalo to where you might move in Rochester and or vice versa, it doesn't meet the 50-mile criteria, so you do not get to deduct moving expenses if you move from one to the other for a job. So you always have to be careful with that, okay? That's where the distance test, time test we're going to talk about, and move is closely related to the start of work. I can't decide that I want to live in Seattle, Washington, go up there, move up there, and live up there. And if I don't start work closely related to that, then basically I cannot do the moving expenses because I really did not move there for the intent of work, okay? So that's where it has to meet that, the closely related to both in time and place to where you work, okay? The distance test, as I talked about, the distance test is if the new main job location is at least 50 miles farther from the former home than the old main job location was from the former home, okay? So again, there's a little thing in there that if you had 10 miles that you drove from your old home to your old job, you know, subtract that from the new job from your old home. And if it doesn't meet 50 miles, you can't take the deduction, okay? And that's why I say you got to be very careful because somebody lives on the east side of Buffalo and moves to the west side of Rochester, they're not going to meet the 50 mile, okay? All right, and there's a great little illustration. Again, as I call them, one of the Monopoly, looks like all the little buildings from the Monopoly board, but we have a little illustration there for the distance test, okay? All right, time test, again, kind of goes through here and it talks about to deduct the moving expenses, one of the following two time tests must be met. Time test for employees and for self-employed, okay? An employee must work full-time for at least 39 weeks during the first 12 months immediately following the arrival in the general area of the new job location. So again, you know, it cannot be a temporary thing to take moving expenses. It has to be pretty permanent. I moved to Seattle, Washington. I worked there 25 weeks and I moved back in a 12-month period. If I took the moving expenses thinking that I was going to be there longer, in the following year, I would have to amend that year's return in order to get, or I should say, pay back that moving expense deduction or adjustment to income that I took, okay? So you got to be very careful with that. And again, this is one that is going to be disappearing for most people except those members of the armed services in 2000 and all right, so for 2018, that's only going to be the armed services. Deductible moving expenses, okay? On this one, the moving of household goods and personal effects, you know, renting a U-Haul, and then the storage. If we have to get one of those pods or pack rats or whatever they call them to store because we can't get into our new apartment or new house. Travel does include lodging. So if we're moving from Buffalo to Seattle, Washington, and I have to spend a night, a couple spots, because I'm traveling with the plants and the dog and kids or whatever, so we can't do it just driving through, but I can't deduct any meals, okay? If we travel by car, we can take a standard mileage rate of 19 per mile on that. Now, it has to be the most direct route to that. I can't leave Buffalo and go see my sister in Memphis, Tennessee, see my half-sister in Minneapolis, decide to go see Aunt Betty who lives in Oklahoma, take a trip up to Mount Rushmore, take a thing through Denver because I've always wanted to be in the Mile High City, and then travel on to Seattle, Washington. I can't do a zigzag and take all those miles, okay? So sightseeing or stopovers that are not necessarily for the travel, I can't take, okay? So basically when you're calculating miles, best thing to do, pop open Google and say, here's point A, here's point B, here's my miles, all right? Lodging, if they're sightseeing tours or visiting family or whatever, again, it's hard to justify those for things that we have, as travel expenses for moving, all right? One thing to remember, a lot of people that may be transferred for work, sometimes they're reimbursed by their employer for those expenses of moving. So that being said, that does not allow them to take the moving expenses adjustment to income because they have been reimbursed for their expenses. So just like anything else, anytime you're reimbursed, you can't take the expense. Okay. All right. A little section talks about some of the form, but talks about, if you took it, then you have to do the amending a return from the previous year. Okay. There's a 3903. Again, right now for 2018, only members of the armed forces, armed services, whatever you want to call it, are going to be able to take this deduction. Okay. Self-employment tax on the top of page 1220. Self-employment tax deduction. If somebody is self-employed and they have a net profit on their self-employment that we're going to talk about in the next couple chapters, they will pay their Social Security and Medicare tax on their tax return. Unlike somebody that's a W-2 employee that has this deducted, theirs is going to be on the tax return. So not only is it taxed income, but they have to pay Social Security and Medicare. Now, what the form of self-employment tax deduction, the Schedule SC does, it allows us to take credit on our adjustment income for half of the self-employment tax. No different than an employer would have an opportunity to take a benefit like this. They allow the self-employed person, since they are basically on the tax return, they're the employer and the employee, they allow them to take some deductions that an employer would get when they calculate that. Again, we'll talk about this a little bit more when we do Schedule C in the next couple chapters, okay? Self-employed, if you are self-employed, you can set up SEPs, simples, qualified plans. These are retirement plans, okay? Sometimes you hear, and I know one that seems to be popular right now, they call it solo 401ks. There's different things like this, but these are basically retirement plans that if somebody is self-employed can contribute to. And again, these are things as tax preparers, we can help with a little financial planning and say, hey, so you're self-employed, you made $10,000, okay? If you don't need to keep that for, personal or living expenses, then let's take and let's do a SEP or a simple and contribute some money to it. And then that will lower your adjusted gross income. That will help us lower your taxable income before the tax is calculated. And again, we can do this after the end of the tax year. So those are things that would be beneficial. For most W-2 employees, the ones that I see right now, if they're concerned because of the new laws about their taxable income or their tax bill, they probably got to figure out a way to max out their contributions to their 401k through their employer. I have known people that plan to retire at the end of a tax year. The one thing they'll do is their last few paychecks, they'll say, put it all in the 401k. Don't even send me any of it. And as long as they don't meet the limitation, and may be beneficial to them because they can load up and get the amount in there, lowers their tax in that year that they're retiring, get some extra money in that 401k for them to have it grow before they may need to access it for their retirement. Okay? So that's these are great things. It goes into the different details of what SEPs and Simples and solo 401ks and all those are. Again, it goes back to what we talked about when we did the retirement section about some of the qualified plans that they are. Okay. Next one, line 29, self-employment health deduction. Again, we're going to talk about this in Part C a little, or excuse me, about Schedule C when we talk about it. But this is basically, if I'm self-employed and I pay for my health insurance, I can take it as an insurance deduction. Now, if I am self-employed and I have a family's return, a spouse who is not in the business and dependents who are not in the business, I cannot take the entire family. I can only take the self-employed person's portion of those premiums, okay? So make sure you understand that. Penalty on early withdrawal of savings. Again, the thing that we talked about, that Schedule B, using that little worksheet. Sometimes when somebody has an emergency situation and they have CDs or they put money into some type of investment vehicle and they take it out prior to its maturity or whatever it may be, that we can deduct as an adjustment to income. And remember, adjustments to income aren't lowering dollar for dollar what you have for a tax bill. Sometimes people, when we talk here in a second about IRA deductions, they'll have that mindset that, well, if I put $1,000 into my IRA, it'll lower my tax bill by $1,000. It's not the case. It's one of those things that, we're adjusting our gross income. We still have to do deductions. We still have to do credits before we get to our tax. So we got to make sure that we understand that it's not a dollar for dollar, okay? Alimony paid, again, if I pay alimony to somebody, okay, I will be able to deduct that. And we've talked about alimony when we talked about income, all right? So alimony that I pay to somebody, again, cash basis, okay? It has to be in the tax year. If I am a month behind and I only pay 11 months in the tax year, I cannot take 12 months just because that's what I'm supposed to pay, all right? Because equally on the other side, the other person has to only claim 11 months of income if the person's a month behind. But equally, if they catch up the next year, you might have 13 months, okay? So for 2018, again, the law is changing because those income and that adjustment income are no longer for any divorces that took place after 2018, okay? IRA deduction, all right? This is one of the most popular on line 32 as far as the deductions to take to help after the end of the tax year. But again, must be contributed to a traditional IRA, a qualified account or tax-deferred type account. Contributions to a Roth IRA are not going to adjust your income, only those traditionals, okay? There are some rules. They must have compensation, again, kind of an earned income. The taxpayer may not make contributions if they have reached 70.5 because that's the RMD. Contributions to an IRA must be made on or before the due date of the tax return. So again, when I say after the end of the tax year, I don't mean a year. I mean just after the end up until the tax deadline of that tax year, okay, the filing deadline. The taxpayer can make contributions for themselves and their non-working or lower income spouse if they file a joint return. And then it shows the limitations, $5,500, $65 if you're age 50 older. They give you a little $1,000 once you reach age 50, a little bit of a catch-up, if you will, to be able to put a little bit more in, okay? Good little chart here with compensation for purposes of an IRA. One that I always think that's interesting to point out is alimony. So if somebody has alimony, and that is their source of income, they can contribute to an IRA, okay? All right. A little form there that they talk about a little bit, and that's the non-deductible contribution portions for calculations on that, okay? Great little worksheet that we have in there. I think I've showed you this, but I will remember to show, I'll make a note to myself here. The what if mode that we have in the software, this is an ideal spot with these adjustments to income to be able to take a look at the what if and say, okay, well, do you have $3,000 that you could put into an IRA? Well, then your tax bill drops to this for the federal. So it's a great thing kind of to help that person with a little bit of financial planning. Do it a lot when I have self-employed people say, hey, you know what, we got a $15,000 profit here on our self-employment. That's going to be subject to income tax and self-employment tax. Can we make a contribution and try to lower that income tax? The net profit may not help us on the self-employment tax, but at least it would help us lower income tax. And a lot of times what happens is then for every dollar that we put in there, maybe only 80 cents is what it really cost us because of our break on the taxes. Okay. There's a little bit with the IRA. When you say an IRA, the 18,000, you're talking about a 401k. You can do a little catch up to 20 once you've reached age 50 on that. So it's a little bit different on the rules. Okay. The 55-65, that's the one that's done as far as the traditional IRA on the tax return, but the 401k rules are a little bit different. Okay. All right, so we have that. Let's see here. Oh, it talks about, if somebody's retirement, that they're covered by a retirement plan at work. Again, little exercise that's in there, very good exercise that you're going to do in the textbook. Make sure you pay close attention because sometimes I will say to somebody that, yes, this is great. I know you want to put each of you want to put $6,500 in a traditional IRA, but really because of their income or the way that they're covered by something at a employer or not covered with their spouse or whatever the rules may be, sometimes it's only partially deductible. So not all $6,500 is going to count. Maybe only half of it will count to help with their adjusted gross income. So again, that what if mode, ideal, absolutely ideal for you to use there. Okay. All right. Okay. All right, so we have that. Student loan interest. I don't know how many out there are still paying on student loans or helping children or dependents pay on student loans or know somebody has student loans, but it is now past credit card and it's on the heels of mortgages as far as debt in the United States. Some people actually probably have student loan debt that is close to or equal their mortgage, okay? But this is a chance for us on personal loans to deduct or adjust our income on student loans. And we can take up to $2,500 for the tax return, okay? All right, we had somebody chime in there. I feel for you, Kristen. I got two that are in college right now. I don't know how I did that with my family planning, but I didn't do a very good job. But yeah, they're going to have some pretty good with the new job that my middle son has that's graduating in December, and my daughter started college, and student loans is it's unbelievable. As Kristen said there, hers are 5 times her mortgage. So, too bad that the student loans, you couldn't get a house equivalent to what your student loans are probably. But student loan interest, you can do up to $2,500 on the tax return. A lot of times when you have married people and you put all their interest together, it goes well past $2,500, but it's capped at $2,500. And the other thing that happens is that it does phase out, okay? So if you're single, $80,000 and joint $160,000, if your income goes beyond that, you do not get to take the deduction, okay? So, it's a shame, and especially for somebody that spent a lot of time in college, has a degree and has gotten a master's or PhD, has a lot of student loan, and they're making a very good living, they're not going to get to deduct that student loan interest, okay? One thing I will say, and I do work with some of my clients, there are a lot of options out there as far as debt forgiveness, for teachers, especially in the state of New York, depending on the school district that you teach in. If you work for a nonprofit for 10 years, there's a lot of different things out there. Don't hesitate. Tiffany that works here at our corporate office is very good with hunting those down for people, pursuing options for them to figure out a way to have debt forgiveness on their student loans. And it's the type of debt forgiveness that won't necessarily show up as a income situation that we would see like a cancellation of debt. This is debt forgiveness, because you have decided to work at a nonprofit or work at a low-income school district or whatever it may be. So don't be afraid to pursue those, okay? One thing I will tell somebody, I ran into this the other day with a client. I know when all of us do things online and we get to that little box and it says read this, and we have to scroll all the way to the bottom and say I accept or I agree, that a lot of times we don't read those. Ran into an individual the other day, and he was deciding that he was going to consolidate some of his student loans into another student loan that had a lower interest rate. Well, come to find out, there was a clause in there that it was not subject to the debt forgiveness that one of the other student loans had. So he basically wiped that out because of the way he consolidated the student loans. So I guess the moral of the story is don't necessarily just scroll through and hit I agree and hit continue on your computer unless, especially in the instances of student loans. Okay. 1098Es that you see here on the bottom of 1231, those are what we see. However, the only way we see them, and most of the time with my clients, is they just hand me their phone with a picture on there. Okay. These are just like the 1099Gs for unemployment. We don't see these mailed very often, and sometimes they just hide on the December statement for somebody's student loans. So make sure that you clients and you ask that they have student loan interest and see if there's a deduction on that, because as we've heard from some in the class, they're fairly common. Okay. All right. Tuition and fees deduction. Okay. This one's a kind of the predecessor of the HOPE American Opportunity Credit and the Lifetime Learning Credit. It is a deduction or adjustment to income. There are instances where this is more beneficial than using the Lifetime Learning Credit. It's very rare that it's more beneficial than the American Opportunity because of that $1,000 refundable portion. But for the Lifetime Learning that is just a non-refundable credit, there's times that you want to take a look and see if this tuition and fees deduction is a better situation. Now, I will warn you when you do that, okay, and you go to line 34 and you go into tuition and fees deduction, make sure that you take it out of the Lifetime Learning before you put it in the tuition and fees, and vice versa, okay? Do not leave them both in, all right? You'll get a love letter down the road from the IRS in New York State saying, hey, you double dipped, okay? And you're going to have to pay us back. So we want to make sure that when we're doing that, and again, another perfect what if mode to see which one's the better situation. Now, just because the tuition and fees deduction does not help you on the federal does not mean that when you do a combination of federal and state that it won't be a better net outcome. So what I mean by that is maybe it decreases the federal, but it might increase the state by more than that to help you in the situation, okay? And we'll try to see if I can do one of those when we do a problem here. I'll just make a note, okay? All right. Okay. Again, the section here on the tuition fees talks about some of the phase out. Again, qualified education expenses, no room and board, okay? So again, those are things that are excluded, okay, that we can't put on there. I think I mentioned with the education credits, always check if you're a student to make sure that if you have health insurance that they're not billing you for it, because sometimes they bill you and ask you that you have to fill out the waiver for it, okay? And that's where we have the end of chapter 12, okay? All right, so we're going to take 5 minutes, come back, and then, like I said, we're going to kind of whip through the chapter on Schedule C's. It's broken into 2 sections. The first section we'll go through pretty quick because it's just kind of talking about the form and the expenses. I want to spend a little more time in the second because it has depreciation in there. So depreciation to read is pretty dry, but I hope I have a method for you that'll make it pretty easy to go through. Okay? All right, so we'll be back. Let's say it's 10:10. Why don't we say 10:20, we'll be back. We'll give you 10 minutes to clear your head and get ready for depreciation. All right, welcome back, everybody. We'll go ahead there. Sorry about a couple minute delay. Finalizing the arrangements if we're going to do it to go with the grandkids down the canal side to see the tree lighting tonight. Never been to it, but thought we'd do it with the grandkids, so hopefully the weather holds out and cooperates. All right, chapter 13. We're going to start, and as you can see here, we got this divided into two sections. We have part 1 and part 2. Really, we're just going to do Schedule C. We're going to go through part 1 and part 2 together. And then at the end, got one problem we're going to do, and we'll try to incorporate everything we've done today in 12, 13, and 14. Okay? All right. Okay. Schedule C is basically like a tax return within a tax return. Okay? It's basically one of those things on here that would allow us okay. And so, you know, basically, like I said, it's really doing a tax return within a tax return. It's, you know, if you're an S corporation, you're going to do it on 1120. If you're a partnership, you're going to do it on 1065. But if you're a sole proprietor, you're going to do it on a Schedule C, which is part of your personal return. So we're going to kind of see like it's a business tax return within our personal tax return. Okay. You know, a lot of people will create LLCs. You can be an LLC and still do your return on a Schedule C. It doesn't mean you have to do a special tax return as an LLC. But, you know, there are some people that are LLCs as partnerships or whatever it may be. And then obviously that is a special return. Okay. LLCs are really, they cost you some money just to set it up to be able to create a partition between your personal assets and your business assets in a business that you may be in. Okay. Partnership, 2 or more persons who join to carry on a trade or business, and each person contributes money, property, labor, skill, anything like that to the business, and as to share the profits and the losses. Okay. Now, a husband and wife can still be considered a sole proprietor and on a Schedule C if they are married and make the joint election to treat their business between them and put it on a Schedule C. Okay, it's called a qualified joint venture. Okay, so I guess a way to look at it is when you're taking your vows getting married, you could say till death and dissolving our joint venture, do we part. Okay, so you know it's one of those things that you can do that, and both have to materially participate in that. We have Schedule Cs and Schedule CEZs. If you look at the top of 13.5, it has a little thing about Schedule CEZs. There are a lot of limitations, okay? The one thing I teach my classes and my preparers and things like that work with me is that I would prefer that you always do your self-employment on a Schedule C, because of the detail that is there, so you do not miss anything, okay? If it's deemed that you look at it and you see that they would meet all of this criteria, then maybe we only charge them for the CEZ. But as far as doing the return itself, I'd much rather when you're doing the return for a client and you're on that Schedule C, or you have the choice between a Schedule C and a CEZ, always use the C. There's a lot of things, like I said, that you know, create a better interview, create more of a thorough inventory, I guess, for lack of a better word, of what expenses and or income they may have. Okay. The IRS obviously wants you to make a profit because they can get taxed and self-employment tax on your profit. But again, you know, sometimes somebody starting up or a down year, they may have losses. But, you know, if that loss and that net loss becomes a consistent and, you know, the losses are excessive maybe, you know, for 3 out of 4 years or 5 years, the IRS may come to you and say, I don't think you're really in business. I think this is just a hobby, okay, that you're using to lower your taxable income. In that case, as we know, we got to take and put our income on line 21, and then our deductions, or excuse me, our expenses go as miscellaneous deductions on our Schedule A if we itemize. And in 2018, we don't get to take that, okay? Accounting methods, don't get too caught up in that. You know, most of the time we're always going to be on the cash method. Okay, so you know that's the one that we want to make sure that we understand that when the dollar changes hands. Okay, talks a little bit about inventory. Again, we'll talk a little bit about cost of goods sold. When I do tax returns for self-employed people, you know, in this day and age of e-commerce, most people do not have inventory. Their business is such that they are really the in-between, the intermediary, the broker, or whatever you want to call it, that they are exchanging things from one spot to another and never really inventory it or possess it or own it. You know, it's all done, you know, by, you know, the Amazon model. So, you know, inventory is not as big. Now, when I have somebody that is a direct sales, and I use the example of a Mary Kay person that has inventory where they receive, purchase stuff, some may be used for personal purposes and something like that, then that's a little bit different, okay? But, you know, we'll talk about that. Again, the problem that we're going to do, we're going to kind of have one that will have a little bit of inventory and stuff, so we'll talk about cost of goods sold on that. Because of the way that a Schedule C works and the way that the income works, estimated taxes, we're going to talk about them in Chapter 17, but it's a very good thing to get somebody that's self-employed that's, you know, running a profit. They better get used to paying those estimated taxes so that they do not have a penalty for their balance due at the end of the year for non-payment, because the IRS wants its money timely, as it says, for those that are self-employed. So quarterly is timely for them. And then obviously, no different than a business that would be paying payroll taxes. You know, you got to be paying the Social Security and Medicare. And, you know, if you had a W-2, you'd have withholding. So pay that throughout the year. So estimated taxes are very important. Okay. As we talk about this, you know, we have to be materially participating in this. Okay. I have had instances where I've had, and again, I use the Mary Kay, where I would have a client and we have a Schedule C, and then they come to me and says, you know what, I switched jobs, or we moved, or I, you know, became a parent, or the grandkids moved in with us, or whatever. I just didn't do it. Okay, well, then they didn't materially participate. It has some rules there that talks about it, but then we didn't materially participate, so we might not have any activity on that Schedule C. We may have some depreciation things that we're going to talk about in the next chapter, and those would continue to carry forward, but again, we're not going to be materially participating, so we're not going to see anything on that Schedule C. Statutory employees. These really, the most common one is somebody that is an insurance salesman, okay? Because they, you know, that's just the way the insurance industry is set up, that they are statutory employees. A statutory employee receives a W-2, okay? Their Social Security and Medicare tax are taken out. They might have tax withheld, but their income shows up on a Schedule C, but is not subject to self-employment tax, okay? But being that it's on a Schedule C with their type of W-2, they can take all the expenses that a sole proprietor or self-employment person could take, okay? All right. Best way to sum it up is right there in the help box. Statutory employee is an employee for Social Security and Medicare tax purposes, but self-employed for income tax purposes, okay? And this is where, you know, we have the little one here that talks about the picture as here of somebody that's a statutory employee. Again, in box 13, you'll see that X. So, you know, if you have somebody that works for an insurance company, make sure you always pay close attention to that, because that's the way that it'll flow correctly onto the, you know, when you do the W-2, that will flow correctly onto the Schedule C, okay? Now, business and income expenses, all right? The header, all right? Seems like it may be pretty trivial, okay, as far as anything that we talk about but it is anything but trivial in 2018. So 17, we kind of talk about the name of the sole proprietor, better known as the taxpayer or the spouse or both if it's a joint venture. The name of the business. You're going to enter the business code, okay? That 6-digit number there that you see that is over there. That is an NAICS number, North American Industry Code System. I forget what exactly the acronym is, but it's a 6-digit code that basically is something that you just Google. I mean, for lack of a better term. In the book, in the textbook, there is a couple pages that shows some of the more popular or more general NAICS business codes. But the biggest thing I want you to know is that for 18, the 20% pass-through, which is the 20% reduction of taxable income that is new for 2018 for self-employed people, is driven by that code. Because if you're a code that is a service industry, your code may not allow you to take the 20%. All right, so you got to make sure on that you get that that code in there. Okay, so that's very important that you get that code. As it says down there in the help box, business code 9999, the 6 nines is available for no other code applies. Do not use that. Do not use that at all anymore. Okay, the reason I say that is because of what's happening in 2018. Okay. Again, here's those pages I was talking about with all the different business codes. One that is very popular, if you look under here under non-store retailers, 454390, direct selling, including door-to-door retailing. Again, one that would be very good for somebody that is in a Tupperware, Party Light, I'm trying to think, Mary Kay, Tastefully Simple, whatever, a lot of those things that they do that people go into other people's homes for the direct selling, okay? We talked about the business name and the address. EIN numbers, again, not imperative, but if you have where you're going to have employees and you're going to pay them, I would get that EIN number. You can do an SS4 online. There's the link there. Don't ever pay anybody to do it. It's very simple. Anybody can fill it out. Don't go to a lawyer and say, hey, can you get me an EIN number, and have them give you a bill for $250 for his time. It's not worth it. You can fill that out. There's a copy of the form right there in 1313, but you go to the IRS website, and again, it's very straightforward, very simple. You ask some series of questions. They've done a great job to streamline it so that anybody can do it. Okay. All right, counting method, again, we're still in the Schedule C going through the sections here. We have the Schedule C there that we talk about, did we materially participate? And again, they want to know, did you pay somebody greater than $600? Then you should be 1099ing them, okay? So we want to make sure that that's understood, that 1099 miscellaneous is issued. All right. All right. Part 1 of the Schedule C is income, and again, it is income, your receipts, your sales, anything. It doesn't have to be that somebody gave you a 1099 to show that they paid you and that's reported to the IRS, okay? So if you have income and you keep track of it and you get paid for your self-employment, you need to report it here, okay? Returns and allowances, again, if somebody's, you're reselling birdhouses and, you shipped a birdhouse to somebody and it was 1,000 pieces when it got there, well, they return it. That's something that you can take out of your sales and reduce because you basically reimbursed them or gave them their money back for that, okay? Cost of goods sold, we'll talk about a little bit. Again, I'm going to kind of do that when we get into the problems. It's kind of sometimes easier to see it in practice than it is to read. 1099Ks, payments. Best example, seeing something like this, somebody that's a e-commerce person has a PayPal account where their transactions are coming in and out. They'll see a 1099K, or somebody that has Square, does their own credit card transactions on their cell phone or on their tablet or whatever. This is a third-party network transactions that's handling your charges because you're not doing cash or check or direct, somebody handing you money. You're doing it something like that with e-commerce, you'll see a statement like this, okay? Cost of goods sold. Again, cost of goods sold. Inventory, we're going to do everything at cost. It's the best way to do it. You know, if you have somebody that's a previous client, their inventory from the end of last year will obviously be the beginning of this year, okay? Purchases, again, line 36 there that's in front of us. That purchase, you know, if I buy things, and again, I use the Mary Kay. I have a lot of those where I say, okay, that's great. You purchased X number of dollars. How much of that was taken out for you to use yourself? And they'll say, well, I kept da-da-da-da-da amount, okay? Now, that may be different than the stuff that they took out for samples, okay? That would be maybe something that we handle a little bit different as an expense, but anything they use for personal use, that would be something that we would do there, okay? Materials and supplies, cost of labor. Again, if I have something that I'm doing more of a thing where I'm buying something and assembling it, I may have those too. And then we have inventory at the end of the year. When that's all said and done, that gets us the cost of goods sold, because it takes what we have, what we added to it, okay, what we didn't use, and that is really our cost. So for things that we have. Now we'll see on the expense side, there's some other things that we use a little bit differently, okay? All right, a little problem there to do some exercises. Okay, business expenses, all right? And I am gonna go right to this section here, because we're gonna talk about each one of them. Business expenses, advertising. These are things after I've calculated my, what would be, you know, my income. These are the things I'm going to try to put against it to lower my taxable income. All right. Advertising. Obviously, you know, I'm going to Vista Prints and buying business cards, or I, you know, did a ad in the paper, or, you know, website you could put under there, things like that. Any way that you're promoting yourself. Car and truck expenses. We're going to see that in a second here, but that's where we keep track of our miles, 53.5 cents a mile that we drive. And again, you know, I use the direct selling, the Mary Kay person traveling to all those parties. You know, that is expenses, okay? So that's where they need to keep track of that. Commissions and fees, again, not used a lot, but, you know, just kind of what it states there, that if we have some commissions and fees that we pay to individuals or somebody that maybe that worked under us, might be contract labor. A good example of contract labor, if you're somebody, I have a client that is in a moving business, self-employed, is not incorporated or anything, but has a moving business. When he gets to the site, when he moves somebody's residence, he has connections somehow, and he is able to hire individuals to help him unload the truck on the other end. That would be contract labor that he's going to give 1099s to. Depreciation we're going to talk about in the next chapter. Employee benefit programs, again, you know, those are things, you know, pension profit sharing, employee benefits. You know, I had, you know, maybe you give somebody dental, you know, you pay for their dental insurance or something, okay? Insurance other than health. Remember, health insurance, we saw that as an adjustment to income on page 1 of the 1040 that we talked about in the last chapter. You know, insurance I'm talking about here is things over and above. You know, as a broker for Medicare, I have to carry errors and omissions insurance that I have to pay a premium on. That would be an insurance that I can write off. Interest, you know, mortgage interest, again, if I bought a building for my business, that may be where the mortgage. Other interest, if I have a credit card that is in the business's name, say I set up a DBA and I have a credit card that is in the business's name. Never do the interest that you do on your personal credit card, because if the IRS were to say, you know, how can we distinguish that? And say, well, I'm building birdhouses. This one's for Home Depot. Well, we need to see the receipt to make sure everything you bought that day at Home Depot was for business and none of it was for personal. So, you know, again, for cleanness of record keeping, you know, best to have a separate credit card that's in the business's name. Legal and professional services, again, if you set up the LLC, you might have paid somebody. You know, paying like somebody like yourself now that you can do taxes, you know, your tax preparation. Office expenses, you know, these are the office supplies, you know, your pens, your paper, whatever it may be, your receipts, your letterhead, things like that. You know, ink cartridges, you know, we will talk about in depreciation, maybe computers. Tough on computers sometimes because they become obsolete so fast anymore. It almost seems like you should expense them, but you know, sometimes they're depreciated. And printers, the same thing. It seems like printers anymore, it's cheaper just to keep buying new printers than it is to buy the cartridges. But those office expenses. We talked a little bit about pension and profit sharing. Rent. If I'm a landscaper and my mower goes out, that we might be depreciating, but I have to rent a mower temporarily to keep doing the business. Another one I see with rent that would be other business property. Some hairstylists rent their chairs at the studios they work at, all right, so or the salons, okay? That would be an expense for them because they're renting that chair or renting that space for where they're generating their self-employment. Repairs and maintenance. Again, be careful with this one. When we think repairs and maintenance, most of the time everybody's mind goes right to the car. If we're taking 53.5 cents a mile, that's included in there. Repairs and maintenance here would be, again, my mowers. Maybe I'm a hairstylist and I had to get my scissors and all my clippers and everything sharpened, okay? Supplies, again, says they're not included in Part 3. If we remember Part 3, that was materials and supplies for cost of goods sold. This case, our supplies is the things like maybe merchandise bags, gift wrap, different things like that, okay? All right. Taxes and license. Taxes that we might pay or license that we might have to be able to do business do not include sales tax, okay? Your gross sales should not include sales tax because you really are just a conduit for that. That is a pass-through. You are taking the sales tax and collecting it for the state and then paying it to them. Don't make it part of your taxable income, all right? Travel, meals, and entertainment. Again, IRS has deemed you have to eat, but half those meals where they're business related. Your trip through Tim Hortons every morning does not count as meals for business if you're self-employed. But travel, maybe again, you're building birdhouses and you're going to go to Chicago for the Birdhouse Expo. For everybody that builds birdhouses, that travel out there for that business sense, okay? Utilities, I like to keep this clean because if somebody owns a building, I'd rather this just be utilities that are traditional utilities, the gas, electric, the power, whatever you want to call it, okay? On page 2 of the Schedule C in the computer, there's an other expenses. I like to break out cell phones and internet separate so that I can type on their cell phone, 30% business use, internet, 50% business use. Because again, your cell phone, your internet coming into your home, if you're home self-employed, it's not necessarily totally used for business, okay? I've had people where I've asked them the question, they go, oh yeah, well I have internet and that's all I do on there. I said, okay, you didn't do any Black Friday shopping? Well, yeah, a little bit. Well, then I can't give you 100%. Okay, so we have to kind of barter, I guess, a little bit to kind of work out what they actually do use, the percentage of use there. Okay, 27A there shows, again, there's a page 2 to the Schedule C, and on there you can do those other expenses. That's kind of an area for anything that doesn't fall in anything we just talked about in lines 8 through 27. Okay, so something that just doesn't feel like you need to give it just a little more description. And again, I use cell phone, internet. Sometimes I'll put on there continuing education. I might put on there something about bank fees. If they do have Square, I might put on their credit card fees, just so that I have a little bit more specific detail for year to year. Okay, so it's a good spot to do that. Lines 30 and 30, line 30, excuse me. Okay, that is our expense used for our home. So if we have a home office, we might be able to write that off. Okay, it is a Form 8829. Now, if somebody does not own a home and rents, or they don't itemize, or things like that, a lot of times taking and doing the 8829 with all the information is not as beneficial as it says on the next line using the simplified method. They basically give you $5 per square foot of what you use at home for business. Just like the mileage at 53.5 cents a mile for your car, chances are this is much more beneficial. Okay, so I would use that. All right. One thing I will say about the home office, the reason they went to the simplified method is the expense business use of the home has been abused. And it's kind of a, if you will, the term red flag. Okay, because if I have a bedroom and I say, Well, yeah, I used the third bedroom as my home office. Well, you just called it a bedroom. You did not call it an office. Okay. Well, yeah, there's a bed in it. Well, then it's a bedroom. Well, the bed's covered in papers. It just is like a filing cabinet. Okay. Does grandma come to visit for Christmas? Well, yeah, and she sleeps there. Well, then it's a bedroom. Okay. So again, I'm not trying to be confrontational, but I am trying to be like an auditor would be. And if sometimes I'm working with somebody right now on an audit for a home office. If I were to hand the auditor pictures of a room with a bed in it, they would go, that's a bedroom because there's a bed in it. Just because there's a desk in it doesn't mean it's a home office. Okay. So be very careful with that one. The other thing is with the home office deduction, as you can see where it falls, there is my tentative profit or loss. Then I have the home office, and then I have net profit or loss on 31. Your home office cannot create a loss. So if I have a $500 tentative profit, and I have a $1,000 home office expense, it just takes my net profit to zero. It does not take me to the negative 500. Okay, so make sure you understand that. All right. Okay. Next couple pages, there are a few lines there. Whoop. Hold on one second here. Got something came across the chat. Wait for it to come up. Good question, Pat, about using the percentage of utilities on line 25 and using simplified method versus doing full. Again, be careful, okay? Because if you are doing the standard method, the simplified method for the home office, it's kind of like mileage. It's kind of including everything, okay? Anything that is on the 8829 is pretty much included in that $5 per square foot. Now, like I said, there are times that doing the 8829 is more beneficial, but it has to be the case that, I guess the example I go back to is my birdhouse builder, okay? He says, well, I built a new garage on the house so I could build birdhouses. Okay, that's great. How big is it? And, tells me, and, we look at the mortgage, he took out a second mortgage or whatever, and the property taxes and such. But when we get it all said and done, I say to him, well, do you park cars in it? Yeah. Is your wife's car parked in it? Yes. Well, she's not part of the business, so you can't deduct that. Do you park your motorcycle in there? Well, yeah. Do you store your Christmas decorations in the corner? Yeah. Well, then I can't take the entire thing. So sometimes that percentage gets pretty narrow, and the square footage gets pretty narrow. And again, I just encourage most people to say, you know what? The IRS has given us $5 per square foot. It's a pretty good, darn good deal. Let's take it. Okay. But obviously, we have to be very careful on determining our square footage too. All right. The 8829 too, to kind of follow up on Pat's question, if I take property tax and mortgage interest on the 8829, that means I have to reduce on the Schedule A what I use. So if I have $5,000 in property taxes and I use $500 on my 8829, I can only use $4,500 of taxes on my Schedule A. All right, so I can't double dip between the two. All right. All right, as I said, these next few pages were just kind of more details. I just kind of wanted to just go through that one part on the just having the part of the Schedule C. Here is, on this image right here, is part 4 and 5. I talked about business or information on your vehicle. Placed in service, the reason that's important is the IRS keeps an eye on that. If I say I placed a car in service on January 1st, 2005, and I'm still driving it, which I would, the intent for that is to say I have to stay with one method. So if I'm going to take mileage and take the standard rate, once I decided and I put that car in service in 2005, I have to stay that way. I can't go and choose which is better, the mileage or the actual, okay? Can't go back and forth because now my car that I bought in 2005 is 13 years old, needs a new engine. Wow, I got a bunch of expenses. The transmission needs to be replaced and the engine and that. Well, this year, my actual expenses are more than my mileage. I'd like to take those. I can't. Once I choose a method, I got to stay with it. Okay. As I said, part 5, other expenses. All right. Those are down there below. And like I said, I like to use these because there's a little bit more room, and then just putting a number in there, and I can be a little bit more descriptive. Like I said, cell phone, 30% business use. Internet, 50% business use. You know, credit card fees for Square account, you know, type of thing. So I can kind of see those, and that's nice when it carries year to year for that. All right. All right. A few exercises there for you to do. Kind of get you used to filling in the information. There's an exercise there that talks about a Schedule C. Okay. All right. So that's the first part of a Schedule C. Okay. Now we're going to get into the second part. All right. Depreciation. All right. And I'm sure if I looked at the screen right now, everybody that is logged into the thing is just checked out, or they just said, I'm going home. I don't want to have to listen to this. Okay. I'm going to go through it very quickly. There's a lot with depreciation, but I want to explain it in a simple method. Okay. I think there's a lot more in this chapter than really needs to be. We've talked about self-employment health deduction. We've talked about self-employment tax. Clergy, I think I sent everybody, I don't know if anybody can type in the chat whether or not that I sent you the clergy cheat sheet. I think I sent that out when I sent out the little thing with the 1099. If somebody can let me know if they got that, okay? But, you know, that's where, you know, we have to make sure on this, okay, that we have it on that. All right, so we want to make sure that follow up with that, okay? Now, depreciation. Business at home, we just talked about. Clergy, again, if somebody knows if they got the clergy cheat sheet, I don't know if anybody's typed in there, okay. Depreciation, again, there's a lot in this chapter on depreciation, okay? Let's see, somebody responded, perfect. Okay, so I'll get that clergy cheat sheet out too. I thought I had sent that with it because I had handed it out in the class on that day. So I'll make sure to send that out with homework, and got to send out some problem answers for you guys too for a few of these chapters. Okay, all right. Thank you, Pat. All right, so we have, this is part 2, and it's going to talk about depreciation, okay? And I'm sure that you read this and go, I have no idea. This is just, you know, you're looking at this, and I know there's a couple of you that are accountant backgrounds, and, you know, the depreciation you spend a lot on. You might even have to have a whole semester on it, or 2. But, you know, for our use for taxes and what we need to know as tax preparers, especially in this basic class, all I want you to think about is depreciation is an expense, okay? Just as we saw, it falls in the expense section of our Schedule C, okay? To take it a step farther, all right, we have criteria that we have to decide if it's something that we can depreciate, all right? So again, expected lifetime of more than 1 year, okay? Can generally not be expensed in the year acquired, okay? So again, I talked a little bit about computers and stuff, but here's the way I want you to think about depreciation, and that's why I say I'm going to make this as simple as possible. Depreciation, in the spirit of Thanksgiving, depreciation is a pie, all right? So I just bought a pie, all right? Now bear with me. The pie is going to last more than a year. I know that doesn't sound appetizing, but I bought a pie, okay? For depreciation, I have to decide how I'm going to cut the pie up and when I'm going to eat it or expense it, okay? So again, this is the best way I've found to simplify depreciation, all right? I can take that pie, and depending on how or the method that I use or the number of years that I can depreciate it, that's how many pieces of pie I'm going to cut up. All right, we're going to talk about maybe I really like the pie. I'm going to eat a lot of it the first year and then save some for later years, okay? Or maybe I'm going to eat a little bit right now, a little bit more next year, and then save some for many years to come, all right? So like I said, I want you to always think of when you get that pie, okay? Now, how hungry am I to eat that pie? And this is where you become a little bit of a financial advisor, if you will, all right? What I mean by that is that if I have a lot of income, I may need more expense in that year. I may need more depreciation, okay? So I am very hungry because I had a lot of income. So I need more depreciation. I need more of my pie, okay? So that's where we might choose when we talk about special depreciation or the Section 179. It allows me to eat more pie in the first year and save some for later if I want to, okay? Or I have a loss, it's a startup. Well, I'm just going to eat a sliver of my pie the first year, and then I'm going to save the rest for future years when I'm hungrier again, okay? So again, this is the best way I found to think of depreciation. Think of a pie, okay? So, and I'll try to use that analogy as we go along. Talks about a lot about describing depreciation. First one, makers, mackers, whatever you want to call it. Makers is the method that we use. Again, you see the acres, the ACRS, is used to depreciate property placed in service before 1987, okay? I don't want to date myself, even though there's a lot of gray in this beard, but the if you have something that you have for your business that you're depreciating that was placed in service before 1987, I'd probably call that an antique. I don't know that I depreciate it, but you know, that's what it is. You're going to basically handle everything with makers. The software is kind of defaulted to do that, okay? So we're going to start with makers, all right? Date placed in service. I stress that it's the date placed in service, all right? I actually had this question about a week ago. Somebody asked, hey, I bought 5 water heaters from my rental properties. I got them on a great deal, okay, at a closeout. Well, that's great. He goes, can I expense them? Well, did you install them? Did you place them in service in your rentals? Well, no. Then no, you cannot, okay? So basically, you know, and we'll talk about rentals next week, but basically what I'm saying is, you know, even though I may have purchased that, if I have not placed in service or it's not producing income in my business, then I can't take it, okay? I have to wait till it's part of the business, all right? Now, make sure, too, that you realize that, you know, that asset that I purchased, not just its price. You know, I can do a bunch of other things to add to it, you know, and that basis may be, you know, adding the sales tax, installation, things like that, okay? So we'll have that, all right? Each one has a property class or asset type. That helps us discover the recovery period, which is how many years could I eat the pie if I wanted to, all right? So that's what the recovery period is, okay? Now, Makers has a couple different methods, they call them. One is the declining balance, and one is the general depreciation system, okay? Or the straight line method. Now, basically what this is again, I talk about my pie. I've decided that I'm going to cut my pie into 5 pieces, but they're not going to be 5 equal pieces. I'm going to eat a little bit the first year because of when I placed it in service. I'm going to eat a whole bunch more the second year, and then smaller pieces for the remaining life of that pie. All right, what that allows us to do is to get as much depreciation in the early years as possible. If I have a rental property, you know, people can be hard on things in rentals, and if I have a refrigerator that I can depreciate for 5 years, well, a lot of times maybe they don't make 5 years. So most of the time when we use this Maker's declining balance, it allows me to get a lot of the depreciation in the first couple years, and then all of a sudden if that refrigerator breaks down and I have to get rid of it, I don't lose out on depreciation, okay? Rental properties, though, you know, they'll be a little bit different. We'll talk a lot more about straight line with that, okay? You can see here, we have the declining balance rates, as they call it, but, you know, straight line, if that refrigerator, we could do 5 years, straight line, we'd get $100 a year, okay? But if we do it in a declining balance in a different method, then you can see that we're going to get a lot more of it up front, all right? Okay. Here's a little section that talks about the benefits, and again, that's kind of what I was talking about with the depreciation methods, the benefits as to what you have there, all right? Here's a table on the top of 14.8 that talks about your recovery periods. You know, again, computers and peripheral printers, they say 5 years. You know, like I said, you know, it seems like each year that goes by, things like that, you know, it's tougher and tougher to get that out of it, all right? Now you know why there's 5-year leases on cars, because of the depreciation with the automobile. You can see all the different things that we have there for the office furniture. Residential rental buildings, you know, we'll talk about in the next chapter when we talk about rentals. Commercial buildings are 39 years as far as the makers, okay? All right, now we have conventions, okay? And this is basically going back to my pie analogy, okay? So we've talked about our pie. We've kind of decided how many pieces we're going to cut that pie into. You know, we know that because of when we put it into service, how much we can eat the first year, how much we can eat the second year if we do that. This also comes into play about when did I buy the pie, okay, to place it in service, or when did I place it in service. Sometimes it's a half-year convention, okay, or sometimes it's mid-quarter, or sometimes it's mid-month. Mid-month, again, you see there is used for residential rentals, but these we will use it, okay? Most everything's going to be a half-year convention for us, unless we use the example that is down below here, okay? And this is the best example I've seen to kind of try to explain how that mid-quarter works. So basically what this is saying is I bought 3 items. My total purchases were $1,300, but because of being in the last 3 months of the year, I spent more than 40% on my assets. I have to do mid-quarter, okay? So basically what this is saying is, you know, of my 3 pies that I bought, the biggest pie was bought in the last 3 months. So that's going to be what kind of dictates how I eat the other 3 pies, or the other 2 pies in this situation, okay? So that's where it says that, therefore, Tom must use the mid-quarter convention instead of the half-year convention for all 3 items. So again, if my biggest pie is bought in the last 3 months out of 3 pies, then I have to use mid-quarter for my convention, okay? Talks a little bit about residential rental, but again, we're going to come back to that when we get into the next chapter, okay? Now, here are the tables that kind of talk about, and the reason you have to know this, and this is one of the things that I'm going to require for the homework, is there is, I think it's 14, is it 14A? 14A? No, I don't know if it's 14A or not, okay? It might be 14A, okay? But there's a problem that's great because you have to do a little hand calculation, and this is great. I mean, the software is wonderful for what it does for depreciation, but there's a, you know, the reason that this is here is because sometimes you have a client comes to you and you don't have any history. And you don't have any information. You've got to calculate by hand all the depreciation, all right? This table kind of shows the different things that the tables you will use for your rates based on how it falls, if it's a mid-quarter, what the class is, the recovery period, the month placed in service type of thing, okay? So we'll have to do all the different ones on there. There's a half year, all right? And you can see with the makers, the declining balance, you can see if I look at my 5-year, I got 52% in the first 2 years. So again, I'm eating most of my pie in the beginning of the life, or the 5 years of my pie, or my 5 slices, or whatever you may call it, okay? All right, section 179. Basically what this is, going back to our pie, I'm really hungry, and I got this pie, and it's my favorite pie, and I'm going to eat the whole thing, okay? So basically, I've had an opportunity to take something and eat the entire pie in the first year. Or what sounds a little bit more like, an expense. And again, that's what depreciation is. But it has to be of a certain asset type to be able to qualify for this Section 179, okay? So again, it goes through the description there. When we get into software, it's very good because it gives you the opportunity based on the correct selection of the asset type. So sometimes it's a little easier to see it there. But again, taking the 179 allows you in a year where you're very hungry, you have a lot of income and you want to reduce that income for tax purposes. And if you have an asset that was purchased in that tax year that is Section 179, I can eat the whole pie to help reduce my tax, okay? All right. Special depreciation allowance, okay? All right. All right. Special depreciation allowance, okay? This one is basically, I can eat half the pie the first year, and then whatever I've chosen as far as the number of slices to have, based on its, asset type or useful life, I can eat those slices for the remainder of the time that I have the pie. So it gives us an option to eat half the pie the first year because we're a little bit hungry, but not hungry that we could eat the whole pie, okay? I know it sounds corny, but I just, from teaching this class and trying to get people to understand appreciation, because sometimes it is just scary, it's the best way I can think of, okay? And right here, it says order to apply depreciation options. Again, we're going to eat the whole pie, Section 179. We're going to eat half the pie, special depreciation, and then little slivers of the pie for the remainder of the time, the remainder of slices that we have, or just regular makers. And I'm going to just slice the pie up and eat a piece each year, okay? All right. Like I said, there's a lot of examples and exercises here. I want you to definitely do 14A, and that 14A is divided into different problems. I think it's problems 1 through 4, if I remember correctly. And I have you do all those different ones so that you get used to coming up with the makers and the class and the date placed in service and such, okay? So I'm going to have you do those exercises for me, all right? All right. Business use of home, we've talked about it. Again, I've talked about the fact that it must be exclusively used. It can't be a bedroom, okay? You have to make sure you use it for what you say the business is used for. Great little flow chart. Again, I talked about some of the questions that I would ask. This is kind of, some of these, looking at these, reading these, is kind of where I developed some interview skills to be able to ask a client, hey, what, let's go through it. Is part of your home used in the connection with your trade or business? No. Well, then you don't get it. Yes. Okay. Are you an employee? Well, yes. Do you work at home for the convenience or for your employer? No, it's just easier for me to work at home. Well, no or whatever. So then that moves on from there. Okay. Talks a little bit more about the simplified method there. All right. So that's a good thing to have with the simplified method worksheet. We talked about that usually is the best. There is the 8829. On the 8829 that Pat was talking about with the percentage is one thing she threw out. If you look on the top there, there's a way that you calculate based on, and one thing before I forget, don't know why they did this in the software, but the simplified methods worksheet, the area used for the home and the square footage of the home is the opposite of what shows up on the 8829. They're in a different order. I don't know why they did it that way, probably just to keep things confusing. But so on the 8829, the area used for business and the total area, that's the order. It's flipped on the other form. You got to give the total and then how much you used, okay? Talks about deductions, and this is one too, when you get on there, like I said, direct and indirect, okay? Indirect would be things like my mortgage. Well, that's the mortgage for the entire house based on per percentage. And again, once I take it on this 8829, then I don't get to take it on my Schedule A, okay? Equally for real estate taxes. Now, if I have a home office and I had to do some repairs because of things that happen in my home office, that might be a direct, or the renting of my home office because I'm renting an office or something. That might be direct. Insurance, again, that's a little bit different. Again, those are kind of indirect. I've had a client ask me, hey, I see clients at home now because I have a home office, and I put a bathroom in for them. Okay, that's great. It's attached to my home office that I use exclusively for business. Okay, great. Is there a door to the living where anybody else can use the bathroom? Well, yeah, we did that for, ease. Well, then it's not exclusive. I can't give you it just as a direct expense because that bathroom is now able to be used by people that may not be part of this self-employment. Okay. You can depreciate your home as part of the 8829. Okay, so it talks about a little bit about the calculation there for that. All right. All right, clergy. Okay. I do quite a few clergy, pastors, whatever you want to call them, missionaries, different people like that. Their tax returns that are handled this way. Again, I'm going to send that clergy cheat sheet out. Really for purposes right now and for time, where it says notes, if you work in an office, you'll have a 20 problems that you'll get, practice problems that you'll do, and one should be a clergy. Otherwise, where it says notes, I would like you to write the letters C, supervisor, okay? The clergy is very odd to do because things, let's see, how do I say this? Their W-2 is such that they don't typically have, they don't have self-employment, they don't have Social Security, Medicare. It's calculated on the return. Excuse me. They have 3 worksheets that are separate. They end up with stuff on a Schedule C and a 2106. So there's a lot going on. And I'm just, for no more than some of you may do clergy or ever do clergy. I know somebody that used to work for EG Tax here in Buffalo that moved to New Jersey. That's what his practice became. He just specialized in doing clergy returns because of the way that they are really got their own little world to them, if you will. So, but the clergy cheat sheet will kind of help you on that should one come up. All right. Self-employment health insurance deduction, we talked about that. Again, only for the person that is self-employed. Okay. Do not take any more. Self-employment tax, really what we're going to talk about here is, if somebody has more than $400 of net income or earnings, they need to do a Schedule C or CE, and they're subject to self-employment tax. Self-employment tax rate on net earnings is 15.3%. You can see the breakdown there for Social Security and Medicare, all right? Also, that net earnings is going to be taxed at their tax rate. Okay, so it's like it's taxed 3 times, if you will, all right? But we do get to take that half of the self-employment tax as an adjustment to income that we talked about in Chapter 12, okay? Really, for most people, when I go to do estimated, this is right where I start, okay? How much money do you expect to make? $30,000. Is that before or after expenses? Well, that's before, Good rule of thumb is, if you got a 20% profit margin after expenses, that's pretty good. Okay, so I'm at $6,000 profit. Okay, well, I'm going to take and I'm going to use my little calculation that you see right there for line 3, 4, 5, and 6. And I'm basically, what I'm going to do is take 92% times the 15.3, and that basically gets me their self-employment tax. That may be where I start for their estimated quarterly taxes, because that helps me make sure they're paying quarterly their Medicare and their Social Security. And then I might have to do a little bit more for the income tax on that income. But that gives me a good starting point for the estimated taxes. Okay. You get to do a little hand calculation there on the different self-employment on the forms. Okay. All right. We got a little example there with some things that you're going to do for some depreciation and some business expenses to kind of do the whole thing there. Okay. All right. And those are some exercises. Okay. So that's 14. So what I'd like to do I don't know if anybody wants to follow along, but I'm going to take 5 minutes to get myself set up here for the problem. But I'd like to do chapter 13. It's page 13-5 in your workbook. The problem is for a Barbara Young. So when we come back after 5 minutes, like I said, I'm going to get set up to do this. When we come back after 5 minutes, we're going to do that problem, and I'm going to add a couple things to it for adjustments to income, but we're going to do that, and actually we'll do her thing where we also do the stuff that she does in chapter 14 where we add in some depreciation. So we'll be back in 5 minutes. Okay, so we're back here, and we have our, like I said, we're doing Barbara Young, okay? Oops. And Barbara is living on Mill Road. And that is in West Seneca. And she has a email of young@gmail.com. We're going to just put in her cell phone number there for sake of time. Okay. We have her birth date as 6/12/1960. Okay. All right. And we have her occupation. She is self-employed. All right. So we have that on there. Now we see that she has a daughter, Heather. So we're going to have her as head of household because she has a qualifying child. And we're going to put Heather in there. Oops. Heather was born on 8/8/2006. We do have her social security number. Okay, it is her daughter who lives with her. And we're going to do that for the earned income. We don't have any dependent care that we have on this. They are New York residents for our example here. We have the bank account information. Okay. All right. Okay, I'm actually got to change this for new corporate address on Colvin Boulevard, in the town of Tonawanda. Phone number is still the same for everybody. Okay. All right. Says from her bio sheet here, again, I'm going on the bullet points, that which is most of this one because of being self-employed. She filed a 1040 last year, and again, that's because she's self-employed because of the Schedule C, but she doesn't itemize her deductions. Okay, so the middle of the 1040, our little box, we're going to check no, that she does not itemize. Okay. As it says there, she supported and maintained the home for her daughter and herself the entire year. She is divorced, so that's where they had a household. We talked about her direct deposit. We've gone through the information there, nothing on the EIC. She had health insurance all year long through the marketplace. All right. And that would generate an 8962, which we'll talk about in chapter 16 when we do healthcare. Okay, because Heather's father, she's self-employed. Okay, so here's how we're going to do our self-employed. We're going to go to our 1040, page 1, and line 12. We have business income or loss. So there on line 12, we're going to light the box up there. We're going to hit F9. It gives us the option. Again, I encourage you to always use the Schedule C. just because of the amount of detail that is there. All right. Okay. All right. So we have Barbara Young. As it goes on to say, on February 1st, 2004, Barb started selling cosmetic products as a sales representative for a company named Mary Jane. All right. So she is in cosmetic sales. All right, we're going to use this as kind of a direct selling. So we're going to use, all right, her business name, we're going to call it Mary Jane Cosmetics. All right, so all those Mary Kay fans out of there, we're kind of closely there. She doesn't have an EIN number because she's not employed with anybody. She's running this out of her home. Okay. All right. Again, she's going to use the cash accounting method. Okay. She did materially participate. And again, she has no employees. She's not doing W-2s or 1099s for anybody. Okay. As we go on to read, like it says, she does not have any employees. She used a hybrid thing, but we're just going to do cash for this. Okay. And she used cashes for expenses and accrual for the inventory. She has not changed accounting or valuation methods. We'll talk about that here in a second. Okay. First line there says that Barbara has gross income of her business of $42,703. Okay. So that is our gross sales down there in part 1 for income. The next line goes on to say she returned $710 to dissatisfied customers. So that is our returns of $710. Okay. Now, one thing I want everybody to notice, if you look up in the top left in the blue box, I have her income in there now, and there is her self-employment tax on her gross income. All right. So that is her income tax, her Social Security, and her Medicare tax on that. Okay. So, you know, obviously we're going to have some expenses that we see here to put against this, but that's where we're starting with her. All right. So that's where we're starting out with her as far as what she has. All right. Now, next line talks about beginning inventory. So on our tree on the left, I'm going to go to our Schedule C, page 2, and I'm going to do our cost of goods. Okay. We fact that she's using cost, she hasn't changed. Okay. So our inventory at the beginning of the year was $27.15. Okay. She had ending inventory down here at the bottom of $25.66. The next line goes on and says during the year she purchased $23,911 of merchandise, and she withdrew $540 for personal use. So here, what I can do is hit my F5, bring my little calculator up. I have $23,911, and I'm going to subtract out that $540. So I hit $23,911 minus $540, and then when I hit enter, pops my number in there. Okay. So now I have cost of goods sold. All right. Now, this is her cost of what she had to pay for stuff to be able to sell. Now, if I go look at my blue box again, obviously my AGI's dropped, but now I went from owing $7,000 to a $1,790 refund. Okay. So that's where our cost of goods sold came in. All right. Next line we start with is that she has expenses for her business. So we're going to go back to our expense section. First thing she had was $200 for advertising. Again, maybe bought some business cards, or that's her fee for her website, maybe. We had legal advice and preparation of tax forms. So legal and professional services, we had that in there for her, $250. We had long distance phone calls. Again, I like to use the Schedule C, page 2 on this one. Okay. And on this, I'm going to do long distance calls, and I'm right in here at 100%. Okay, so it gives me a chance to be a little bit more descriptive. And I took all 100% of that. So we have $73. All right, my next one is a business license. So I'm going to go back to my Schedule C, page 1. All right, and she had a business license, so we have a line there for tax and licenses. So we have that of $95. Catalogs, I'm going to call that supplies. Again, I told you that I kind of use that for, catalogs, maybe gift bags, whatever it may be, things that aren't part of my inventory or purchases. So I have that of $382. Okay. I have postage, envelopes, and mailing supplies. I'm going to put that under office expenses. Okay. And the last one I have is $500 for insurance. Okay. All right, so we have that. And then the little line down there below says she traveled 13,623 miles for business. Okay. Now, I'm going to go over to page 2 of my Schedule C, and then I have information on my vehicle. It says she placed it in service June 3rd, 2012. And again, that's important to the IRS because they want to know that you've kept using the same method, whether it be actual or the mileage. In this case, we're going to do mileage. We have on here her business. She drove 13,623. Okay. We have that commuting, she did 2,100. Okay. Now, the important thing is to check this box because it says check box to calculate business miles at the standard rate. This amount will be listed on page 1, line 9. Right now, I put the miles in there, but it doesn't do anything. If I do this, calculates it and takes me over to my expense, where I'll show you in just a second. We answer our due diligence questions. All right, as far as the information about the car. All right, and if we go to our Schedule C on the other side, we can see our biggest expense, and this is not something that is uncommon, is the business mileage there. Okay, so everything goes down through there, and we can see our net profit. All right, so we have everything on there. All right, now the only thing left is on page 13.7. There's a little document with some dividends, and this is a perfect one for us to show here because of what I saw with some of the errors on the midterm. So I go into line 9A. I light up my box there. I hit F9. I'm going to grab my Schedule B where I put dividends. All right. I'm going to go down to the dividend section in part 2, light up my box, hit F9 again. And this is where, like I said, you have to get used to using this forms. On the B, the D, and the 4562 that we're going to talk about next, we have to make sure we get used to putting that in there. Okay. Now, I have, in this case, on her form, I have from First National, I have some ordinary dividends of $159.37. I have some qualified dividends of $45.22. I have some capital gains of $23.5, and I have foreign tax paid of $375. So we don't have a spot for that on our worksheet here. So I do have to go to the 1040, page 2, and go down to line 48, as Dave pointed out earlier, and make sure we put 3.75 in there, better known as $4. Okay? All right. So I have that in there. So I have everything on there for my return. Okay? So we have our information that we have for the return. Grab the sheet here. Hold on 1 second. Excuse me. Okay. All right. So we have all that in there. Okay. Now, I'm looking at this and I'm saying, well, she's in a pretty good position. Okay. I'm going to take a look at the return. I want to kind of show you how something works like this with somebody self-employed. No W-2. Have her business income, have her little bit of a capital gain that we saw there, We have our self-employment tax deduction. All right. Okay. We have our income. Had a household. She's got negative. So really, even our refundable credits, nothing works there because we have no tax. All right. Now, down here, though, I do have self-employment tax, and you can see it comes in after our non-refundable credits. So there's nothing here that's going to help eat that up, nor is there anything we could do on our adjustments to income to help us. This is a tax that we're going to pay because it's Social Security and Medicare tax on our self-employment. So we have that tax. She's earned the earned income credit because of her head of household with the child. She has the additional child tax credit based on her income. So that's where her refund of $23.30 comes in. Okay? All right. And then we'd want to go down here at the bottom and obviously put in her bank account information. Now, if she had a balance due, this is where I would come in with these adjustments to income I'm talking about. So I might say to her, you know what? You're self-employed. I'm going to go in there. We're going to do a contributions to your retirement because we want to lower your income. So I go in there to my line, and you can see here, here's that table that we saw in our workbook, excuse me, our textbook, but it is here in the software, and it has that little chart that we talked about the limitations. Same thing down here for the Roth. You can see up here at the top, it talks about the covered or non-covered so that they know. And that's where, you know, that box that says retirement plan that is on the W-2 becomes so important that it's checked correctly. And we can see here, because of her age, 57, she can contribute. All right. So we're going to say on this one, she's going to contribute $1,000. Well, again, because she has no taxable income, it doesn't help us. Because you can see here, deductible IRA contributions is $1,000, but it didn't change anything on our refund. Okay. Now, say she makes a mistake and put too much in, she put $7,000 in there. Okay. All right. Well, $7,000. Now I created a form over here, and I have a penalty of $500 or 6% because I had excess contributions. Okay. Excuse me, $30, $500 extra contributions to $30. So again, that's where you have to be careful, but the software will do a nice job of calculating that for you. Okay. All right. I forgot to do one thing here. Hold on one second. Take this out. Okay. And to do this for somebody, the best way to do this is if I go up to File, I go to What If mode. All right. And it turns it green around the outside. I can put that $1,000 in there and say, let's see what it does. Whoop, doesn't do anything. Okay. Well, since it doesn't do anything, we won't do it. I go to my What If mode. All right. Once I'm on my What If mode, I say no. Okay. And there I am all set. Okay. All right. Now, that was 13.1. So I don't know if anybody wants to make a note, but that's the answer for 13.1 on there. Okay. Now, if you go in your workbook and you flip over to page 14.3, this is where we're going to do some depreciation. Okay. So we have some depreciation to do. All right. All right. Okay. All right. So we have some depreciation to do on this one. So we're going to go to our Schedule C. We're going to go down to our section of expenses. And again, that's all this is. And this says depreciation and section 179 expense deduction. All right. So we have that. We go in there, hit F9. we're going to get our 4562. Now, I mentioned earlier, Schedule B, Schedule D, 4562. We're going to put those on the tax return, but is not where we put the information. Okay? So we have our 4562 up here at the top. Her business is cosmetic sales. All right. Now, right here under the form 4562, there it says description of property. I love the things that it has written in red. For accurate computation, F9 to worksheet. Well, nothing could be better than doing an F9 to worksheet. Okay? I like accurate computations. All right. So we have our business asset worksheet. All right. On this, if we read there, Barbara purchased a printer, copier, scanner for $16.99. IRS is a little archaic. They still call this data handling equipment. On April 14th, 2017 is when she purchased it or placed it in service. She uses 90% for business, 10% for personal. She would like to take the depreciation over the allowable years for the office equipment. Also on this bullet point is Barbara wants to take the business use of her home. Her office used exclusively for her business is 250 square feet. Total square footage of the house is 1820. Okay? So we're going to go in there. We have a printer. Okay, again, description, I'm sorry, first. Printer, scanner, copier. All right, and we go down here to our asset type. A whole bunch of things pop up, okay? Yes, there's things in here for cattle. There's some things in here for, fruit-bearing shrubs and goats and sheep and horses, but data handling equipment, okay? So that's our asset type. She placed it in service on April 14th, okay? If we look down here below, we have our method, we have our recovery period, and we have our convention. Because of what we chose the asset type and what we default in there, everything comes down there the way it should, okay? Her cost basis, she bought it for $16.99. And if I look right here, personal use, or excuse me, business use is 90%, okay? All right. So you can see that it calculated for me the 90% as the current year depreciation. All right. Now, it is saying that this does qualify because of the business I am in with my business code and my special depreciation. I could take that, or I can do 179. All right. So let's see what each one of those would do for us. Okay. Right now it said that she wanted to just take it as the allowable years, so she's taking it over 5 years. First year 306, next year is 489. Okay. Now, on this, what I'm going to do is I am going to do a little what if here. Okay. And again, take a look at the blue box. Here's where our refund is at. She's going to take, because we have some profit, I'm going to take this as a 50% special allowance depreciation. Okay. Once I do that, you can see that it took $765 of it, plus I get the $153 for this year. And then I'll be depreciating the remaining half. So really in the first year, you get the special plus the first year's or the current year's depreciation. Okay, so you get those two together. So those are the slices of the pie that I get. Okay, that's with that one. Well, I don't like that one. All right, I'm going to take a section 179. So I'm going to come down here below, do qualify. I'm going to take the whole amount. Okay, so I am going to take the basis. All right, I am going to take, and I can see right there on line 3, I can take the 1529. Okay, so you look, now there's no basis left for depreciation. There's no current depreciation because I took it all. I ate the whole pie. And you can see what that did to a refund up there. Okay, because Her refund dropped, even though we had an expense, because of the earned income credit for her, okay? So again, we can make business decisions for, yes, it's going to lower your taxable income, but in this case, we would lower our refund because we're lowering our earned income. So we'll save that expense for later to maybe help us down the road, okay? So we have everything on that, okay? Now, she also has business use of a home. All right. So if we go down here, she'd like to do the simplified method because that's all we have there, okay? And she has total square footage of the home is 1820. And business use of the home is 250. So again, that works out to 1250. There is her net profit for self-employment tax, and that will be her taxable income with everything that's on there, okay? Her AGI drops because of the credit for the self-employment tax. Now there's a little one on there that I'm gonna see if you can figure out and see if anybody remembers from way back when. So I'm gonna kind of leave that for the homework. But that Barbara is a New York State resident. And then it says something about her not living in public housing or nursing. All right, if you remember, there's a line on page 4, a credit in New York for somebody that has rent. And what I want you to make note of is that her rent is $450 a month. So if you can make sure to make a note that the rent is $450 a month, okay? So I bet there's a little credit that she might get on the New York side. All right. Okay. All right. Now, one other thing I wanted to cover is I talked about that tuition and fees deduction. Okay. It goes here at the beginning of, let's see, there's one for problem. Let's see here. I want you to, okay. The Hamilton problem. You're going to be doing problem 12-1 is one of the homework assignments. I want you to do it 2 ways. I want you to do it as a lifetime learning, and I want you to do it as a tuition and fees and tell me which one's greater, okay? So I'll remember to make sure on that because that's one that we'll be able to go through at the start of class. Next time I'll kind of talk about how those two work together, okay? All right, so I will cover that when we do the problem at the beginning of class next time. Okay. All right. So that's what we have for today. Does anybody have any questions about anything that we covered? I hope that I eased your mind on depreciation. I just, you know, I cringe at the fact every time I have to teach it. I'm going to have to teach it to you again in the next chapter, a little bit more so, because of the things that we do with rentals. You know, with selling a rental or whatever it may be, we'll kind of bring a lot of stuff together. But really next week with the stuff that we're going to be covering, let's see, we'll be covering rental income and healthcare. Really, that's it. We're through the meat of the class, okay? You know, some of the things we're going to do in the last few weeks are just kind of tying some things together, little odds and end things that we do with the different type of stuff, okay? So, but, you know, we've really covered most all of it. Like I said, everybody did great on the midterm. I hope that helped at the beginning of class that I went through it and kind of gave you the ins and outs. There's a good summary of everything that we've done to this point. Again, everybody's doing a great job. Keep sending me the homework so I can kind of see where everybody's at. It helps me a lot with what I talk about in the class and what I review things on. Okay. All right. Question written, page 3, question 7. Okay, let me grab a. Okay. Question 7. Oh, the one about the medical expenses. Okay. Yeah, that one, I thought they had edited that. That was a question that we had we pulled from a previous year. It used to be that you had a choice of taking 10% if you were over 65, or excuse me, 10% if you were under 65 and 7.5% if you were over 65. There was when the ACA or Obamacare or the Affordable Care Act, whatever you want to call it, first came out, there was a distinguishing between somebody under 65 and over 65. Okay, and then I think that was the one you were talking about. Another one that was kind of tricky Saw a lot of people with the 2 conditions, page 1, number 4. You know, they were really looking for ordinary and necessary on that one, but, you know, I didn't really mark much off on anybody for that. The other one, let's see here. I think that was good on those. Any other questions? Good question, David. Good catch. That you know, was kind of a combination of a couple tax years, or tax laws, I should say, in there. If Barbara Young has a refund based on EIC, who pays the self-employment tax? Well, good question. She really is. It's there. She's getting credit for it, but basically it is. It's not part of her. How do I want to put this? She doesn't get as much of a refund as she could if she was not self-employed, because it's cutting into her refund. So she's paying it out of the refund, if you will, okay? Let's see, child tax credit, if zero due, do you go to additional child tax area? Okay. Nope. Remember that the adoption credit's a little bit different. It's a non-refundable that has a carry forward. The additional child tax credit, that's just the child tax credit. If you don't have any tax bill to eat up, you can get up to $1,000 on the additional. They don't flow to the same spot. They're really two different. Okay. All right. Can you leave it unlocked? Leave that front door. Yeah, I got somebody coming in. Okay. All right. Okay. So yeah, so that you know, that's where we have, you know, the you know, there's a difference between those two and the way they're handled. Dave, child tax credit, if it's zero, like Barbara Young's, that's where she gets it as the additional child tax credit. On the adoption credit, you don't get that in the refundable portion at the bottom, but the adoption credit does carry forward to the next year if you do not use it. Okay. All right. Any other questions? I'm looking through my notes here. I don't see anything else. Okay. All right. Let's see here. When you go to additional child tax credit, general rule. Additional child tax credit, everything goes there. Basically, I think the question is if you don't have any tax due. If we look at Barbara here, you can see that, you know, because of her self-employment and her thing, she has no taxable income and has no tax. So even the $4 that we had for the foreign tax credit does us absolutely no good. And because the child tax credit, we have no tax to eat it up because the foreign tax would do it first. That means that everything comes down to the additional child tax credit down here. Again, because her income is limited, her gross income is smaller, then her child tax credit is smaller. Okay. Does that answer your question, David? I think that's what you were looking at, as to how you get down there and add that when you go to the additional child tax credit. Okay, good, good. All right. Any other questions there? Any other questions? All right. Well, everybody have a good week. Remember, it is December 1st. So for those of you that have not started, that means you only have 24 shopping days left till Christmas. The other thing being December 1st is you only have 30 days to get things done for your taxes unless you're planning to do an adjustment to income, what you learned today. So based on everything else, unless you're going to try to use one of those things we talked about with the adjustment to income that we talked about in Chapter 12, you need to get things done. That is a theme today for Esther's show. She's really got making her list, checking it twice. You know, going to find out who's paying taxes, because that's what she's doing with the show today, is talking about those things you need to get done in the next 30 days. Okay. She's used the radio shows on 3 p.m. on WBEN. So I don't know if some of you are listeners, but she's got a great show going today with that. All right. If there's no other questions, I will plan to see everybody next week. I will this afternoon send out the homework. I'm going to send out the answer to some problems that I haven't sent out yet, so that you can check your problems and let me know. Like I said, everybody's been doing pretty good on those. And we'll have that. And like I said, next week's our real last meat and potato as far as topics. Things we'll do the remaining weeks is cleaning up, and we'll spend a lot more time in some problems, reviewing things, going back. So, you know, start to get those questions together, kind of like we had today at the end. You know, make a little list. Hey, I'm still not sure about this, or I don't understand that, or how does this work, or what do you do with this? You know, start making that list, because those last few classes, I love to do that. You know, a lot of question and answer type thing. Okay. All right. Everybody, like I said, have a great week. And we'll see everybody next week.